It's interesting to see what's taking place in the market and the volatility. Where when the market pulls back, which you haven't seen in a few days, but when the market pulls back, there's industries that money's clearly flowing into. So it's not a massive sell-off in every single sector and stocks, which we saw in January and into February, especially when Ukraine, Russia really started heating up. That was on top of the Fed going crazy and saying, well, all of a sudden it's not transitory inflation and we're going to go crazy and raise rates like nuts, right? That was in November. But we saw everything get hit. It didn't matter if it was Bitcoin, gold, didn't matter. Every single thing got hit. Banks got hit, everything. But now, if you've seen over the past couple of weeks, when the market pulls back, gold has been a safe haven, uranium, agriculture, many commodities, including oil. And these sectors seem to get hit when the NASDAQ does well. So if you're looking at this market and where we're going to be, because we still have tons of problems, inflation's out of control, supply chain issues are worse today than they've been any single time since COVID. Any single time since COVID. And again, I track this stuff, and they have satellite imagery, you have Goldman Sachs, you have IHS Markit, which just got bought by S&P 500. Those guys have been tracking this for 25 years. Both of them are saying their latest reports, which are weekly, which I read and I get, it's horrible. It's horrible right now. So you're looking at earnings. I can't see earnings exploding, although you're going to see more buybacks this year than in the history of the markets. It's going to be more than $1 trillion they're expecting. I think it might have hit $1 trillion last year, but it's going to outpace. That's just flush with cash on balance sheets, and they're going to use to buy back their stock. I don't know if that's going to be enough to keep a lot of these stock prices higher. Some of them are going to do well. Like I said, it's not all sectors. I love the separation because that provides a stock picker's market. But the two sectors I love the most right now, if you're looking at the next year, 2 years, 5 years, even into the future, two sectors. It's banks and crypto. And why is that? Because that's where trillions of dollars are going to flow into. And starting with the banks, they make a fortune off of higher rates. And if you want to know how much, and I covered this a little bit last week, but State Street came out and said they're going to make $25 million each quarter for every 25 basis point hike. Let's put those numbers in perspective, which I didn't do last podcast, which was last week. So that's $100 million a year, right? If you multiply that, again, that's for every 25 basis point hike. If you multiply that by 5, which is expected this year, right? At least 5 rate hikes. When I say 5, I'm counting, 25 basis point hikes. There could be a 50. That would be 3 instead of 2, right? So they're expected 50 basis point hikes going forward, at least 2 more. So that's 5. It could be even more than that. But say if there's 5 rate hikes, right? 25 basis point increases, 5 of them. That's $100 million, right? So $100 million, which is expected this year. Now, State Street is talking $500 million in pre-tax earnings. That's how much it would be with 5 rate hikes. $500 million pre-tax earnings, which cost almost zero to them in terms of overhead or anything. They're doing the same exact thing they always did, right? $500 million, just getting $500 million in cash. Now, to put that in perspective, State Street earned $3.2 billion in pre-tax earnings. So if you're looking at that $500 million on top of that, that's 15% growth in those earnings, which is likely going to be, if I had to guess, over the next 12 months, 3 times faster than the average S&P 500 company. That's how fast State Street for doing nothing. And I'm not talking about all the other money, the other $3.2 billion they generated. This is free money to them. Free money. So they're doing exactly what they're doing right now, lending out money, but only at higher rates. And this is not fee income. This isn't the fee income, right? So that fee income, that helped them generate $3.2 billion, right? This is interest income. And if you're looking at the banks and you listen to what they're saying, it is incredible because there's something very important you need to know about banks. And this is a hidden catalyst. We know when interest rates go higher, the spread routine, they make more money. We hear that all the time. I'm going to tell you something that you're not hearing. You're not hearing out there with the banks. Okay, few are talking about it. I haven't read much about it. I've read it. One report talk about this. Okay, so banks capture that margin between what they borrow and what they lend. But with rates so low, they generated little interest income over the past how many years? So most of the earnings we generate through fees, which is investment banking, money management, credit cards, mortgages, deposits. That's great. They generated huge fees on that and record profits without the interest income. Now the Fed is aggressively raising rates, which means all the banks are going to start earning a lot more in interest income. Again, which I just explained. Here's the huge catalyst with banks. So usually when the Fed has a tightening cycle and raises rates, the saving rate for banks go up so that people keep their money there. However, banks are more flush with cash than they've ever been in the history of this industry. So while rates are rising, they do not plan on raising their rates on savings accounts, at least not this year. That's money they have to pay out. So by the way, if you keep it score at home, that's called deposit beta. Again, fancy term, which means the margins a bank makes lending money minus the money it pays out on savings accounts. So sell-side analysts, they do great research, but what they're going to do is they're going to compare this cycle, this tightening cycle, to the past major cycle where we saw massive inflation, which is the 80s. Right? That's how they model. You always look at comp. It's called comparative analysis. This way you can look at what happened in the past, and this is how I'm basing my model in the future. And then they fix the numbers to come up with some kind of target price, right? That's what they do. But they're going to model for their margin to go up a certain percentage based on the last time we had massive inflation, where we raised rates aggressively like in the 80s. So this is when we had mortgage rates at 15% and the savings rate, which people don't talk about. They say, the mortgage rate, how could you pay that 50%? The savings rate was 12%. CDs were paying 18% back then. So it wasn't a worse scenario if you had cash. It was a great thing if you had cash. It was terrible if you had to borrow money with high interest rates. My point is, banks are not going to have to raise saving rates at least over the next 12 months. They're flush with cash. So that means their margins are going to explode like no other time in history. Because they're basically getting tens of millions in free money simply by doing the same job they've done for the past 50 years. In other words, hundreds of millions of dollars for mid to large cap banks that they're going to generate at almost zero cost. So there's a bank, Triumph Bank Co-op, which I'm looking at all the banks and all the quotes from the banks. I want you to listen to what they said. This is last month when they report earnings. They mentioned this. As we move into this, what looks like a rising rate environment, we're in a situation that's pretty atypical with the amount of liquidity that the banking system in general has. Our competitors are flush with liquidity. So I don't think any of us are going to be in a rush to be the first ones to start to raise deposit rates. So I think early on, it's going to be fairly low. Longer term, it remains to be seen. That means they're going to make, excuse my language, a shitload of money with interest rates higher, but they're not going to have to raise that savings rate, which is money coming out of the bank, right? So if you look at Stifel Nicholas, and I mentioned this last week as well, their investment banker lender, they said, let me be clear. This is what they said. This is a month ago. Let me be clear. Our base case calls for us to increase our net interest income in 2022 by close to $150 million on balance sheet growth alone, right? So without rate hikes. Then they go on to say, if we get 3 rate increases that we expect, and it's going to be a lot more than 3, but they're saying 3. That's what I'm modeling for. I should say beginning in March, right now, our net interest income could possibly increase by approximately $250 million. And they say, given a low compensation attached to net interest income, meaning that they say right there, we're not going to have to spend money for more people or anything like that. There's low compensation, right? This would be a significant driver of a bottom line in 2022. This is not being factored into banks, and they're still down well off their lows. So guys, here's the plan. You're not going to hear this out there, but here is the master plan, okay? Not only should you have banks in your portfolio, since you're going to see massive earnings growth for at least the next 18 to 24 months, but it's probably better to transfer some of the cash that you have in your bank, which is in a checking, savings account, money market accounts. Again, with inflation, you're getting wrecked. Transfer that money and buy a large cap bank with it. You're going to earn at least 2.5%, right? That's the yield that they're paying. So they're paying 3 to 4%. But more importantly, if you're keeping it at a bank, if you're keeping your cash at a bank, and they're not going to raise deposit rates, right? And I've seen this from several banks. They're not going to do it, at least in the short term. That means you're going to get destroyed, absolutely destroyed by inflation. However, if you take that money and buy a banking stock, it puts it in your favor. It reverses it, right? So this allows you to take advantage of that massive inflation instead of getting hurt by it. By buying the actual bank instead of keeping your money at a bank. Of course, there's risk to owning stocks compared to just, having your cash sit in a savings account, which makes you sleep at night, and people don't understand how much they're losing with inflation. Inflation's out of control. But there are risks. So don't throw all your cash into a banking stock. We could have a crisis that everything gets killed. Don't throw all of your cash in there, especially if you need to be liquid and you need it. And again, you could sell your stock at a bank and have that money probably within a day or two. But for me personally, I'm putting 30% plus of my cash in banking stocks. One of them I just recommended, a Curzio Venture Opportunity, which is actually a small cap name, massive deposits. I think it's about a 2.83% yield, right? So massive deposit plans on lending at much higher rates, waiting for this moment, and roughly 70% of their assets are in 2 states. You want to know 2 states? Florida and Texas. So those are 2 of the best in terms of population growth and super low taxes. These guys have it right, expecting this environment. This isn't a boring stock. I'm looking to, let me keep my money here and earn 2.8%, 3%, whatever. No, the earnings growth, these are the new growth stocks. The Fed's definitely raising rates. These guys are going to make an absolute fortune. And that one negative they usually have in rising interest rate environments, they're not going to have to raise those savings rates, which is money coming out of the banks right now because they're so liquid. That's really interesting. And I don't see anyone modeling for that.